This week, there's only one story you need to focus on. Not the war between Israel and Palestine, not even Bitcoin, which itself is a news story, but upcoming earnings announcements on the biggest names in the industry. I'm talking about companies like Amazon, Meta, and Microsoft, among others. Today, I'm going to show you exactly how professional traders, as well as myself, predict the movements of these stocks going through earnings. Hey folks, Tom Gentile here. If you've ever traded stocks into earnings, then you know exactly the kind of anxiety that comes along with it, especially right after an earnings report. And then waiting for the markets to open the following day so you can get out of your position. I've dealt with this as a novice option trader, and I've also suffered the consequences by not knowing this simple formula that I'm going to teach you today. So back in the late 80s and early 90s, I worked for a company called Home Depot. I started in the plumbing department. I moved up into management, eventually their IT department. And that's where I started to understand numbers and financials, et cetera. You know, back then, they used to grant stock and stock options to their employees. I don't know how they do it now, but back then also was not long before I figured out that I could trade these options publicly on my own. I didn't need to wait for a grant that came every single year. Their stock actually traded on the NASDAQ at first, and then it eventually switched to the NYSE. I also spotted what would be the first of many patterns that I would come to trade. Now I noticed that Home Depot stock would jump after every earnings report back in the late 80s and early 90s. So my plan was simple. I'm going to buy as many out-of-the-money call options as possible and sit through the earnings report, because the jump, I was destined to be a multimillionaire by doing that. Well, you know, it worked for the short term, but eventually I was losing money, and I was losing big, because even if the stock was going in my favor, the options were falling apart. They were basically expiring worthless. I even remember thinking, wow, I'm even with the stock going in my direction, I was still losing money. How could I figure out how to lose money with the stock going in the direction that I expected to go to? The problem is that I was doing what every other retail trader was doing. I was thinking that something was going to go up and that I was going to make money off of that move without actually understanding a formula of how I could predict how far that stock was likely to move. And what you need for this formula is you need options. You need to look at options, because options can help you predict future price movement, especially during an earnings report. So I want to give you a simple formula to follow. It's on the screen right now. Take the at-the-money call plus the at-the-money put. You put those together, it's called a straddle. Now that's also going to be our predictor. We're going to take the expiration date that is just past the earnings report. So when you take the price of the at-the-money calls and puts and add them together, that's it. You're getting not only a straddle, but you're getting a number that you're going to use as the over-under. That's the over-under on how far the stock should move on average just after that earnings report comes out. So let's try it out. Now, last week, Tesla was due to report its earnings. Take a look at the chart here on the screen. The stock had dropped significantly, but many retail traders were thinking there was going to be a bounce regardless of what was reported. In fact, some retail bulls were thinking Tesla was going to jump back to its July highs, while there were bears out there that thought Tesla was going to $200 a share immediately after the earnings report. Well, what ultimately happened? Take a look at this chart here. This is an options chart, and if you read it left to right, you'll see the area I have highlighted is the October 20th 242.50 calls and the October 20th 242 half puts. Now, when you add the offers, the asking price together, you're going to come up with about $16.50. So those are the near money options. They both have just a few days to expiration, and what we're doing is we're adding up the at-the-money call and the at-the-money put. So the straddle, the cost to buy that straddle would be around $16.50. So right there, $16.50 is your over-under. You take $16.50, you add it to the price of Tesla, and you subtract it from the price of Tesla to get the over-under. Now, what ultimately happened? Tesla missed expectations. The stock dropped around 20 points to close out the following day. Not perfect, but let me tell you something. our options predictor was a much better number to use than what retail traders were looking at, thinking it was going to go up 50 points or down 50 points. In fact, the stock, when it opened the morning after Tesla reported earnings, guess where it opened? Down about $16.50, exactly what the straddle said. So, knowing this simple formula, let's take a look at the upcoming FANG stocks that are reporting for the rest of this week and using our expected range formula. So what I've done is I've looked at those near money calls and near money puts for Microsoft, for Google, for Meta, and also for Amazon, all due to report earnings this week. Microsoft is seeing a 15-point range. That's the over-under after its earnings report. Google, $7 over-under after its earnings. Meta, 27 points. That means $27 above and $27 below. That's the range that Meta has after its earnings. And Amazon's going to round out the week with its over-under range. Again, we're taking the at-the-money call and the at-the-money put, adding them together. And those are the options that expire this week. So it has an $8.75 range after its earnings report. Again, what did we do, folks? Very, very simple. We just took the options that expire just after the earnings report. We take the at-the-money call, the at-the-money put, add those together. That's the straddle. That is the range. Very, very simple indeed. So in summary, I mean, this is by far the easiest way of predicting stock range that I've ever found. It doesn't predict whether a stock's actually going to go up or down. It's also not perfect. And like anything in the markets, there's no guarantees. But you might wonder, what good is this thing if I can't predict whether stock price is going to go up or stock price is going to go down? Let me tell you this. Here's a quick question. Are there option strategies that profit regardless of market direction? If you know the answer to that, then you know there is an option strategy that can make money, that has a high probability of success using this formula. And we'll get into that in a future discussion. We'll see you soon.